Investors that would like to hedge the currency risks associated with their investments have now got access to an increased array of Islamic derivative products structured as Islamic profit rate swaps or FX swaps. Examples of where these products have been used include a few transactions that have been done in the UK market. The Dubai Ports Company recently acquired P&O, which is a British company, which was part financed through a $3.5 billion sukuk issue. Also, a Kuwaiti-led consortium acquired 100% ownership in Aston Martin, which was also financed on a Sharia-compliant basis. And recently, the Grosvenor House on Park Lane was sold and financed through a Sharia-compliant structure. We'll take a very quick overview of the sukuk structure, which, as I explained before, is basically behaves like a capital market instrument. A sukuk is meant to be a security or a certificate which gives investors a share in the ownership of certain underlying assets. This ownership can be established through legal title or simply through a beneficial interest in the assets, depending on what the nature of the assets is and how it can be transferred into issuer vehicle or a special purpose company. Diagrammatically, I'll show you the sukuk structure for what is called an ijara-based sukuk or a sale and leaseback-based structure. This is the most universally accepted and simplest structure that has been used in a number of previous transactions. The issuer of the certificates is the entity in the middle, titled SPV. This entity acts on behalf of investors by declaring a trust in favor of investors. It will acquire legal ownership of certain assets through funding that it receives from the investors and then lease those assets. So the investors will fund the SPV. The SPV will use the money to buy certain assets on behalf of those investors. Once those assets have been transferred to the legal vehicle, it can then lease those assets back to the same entity from which it was purchased or to any other entity. The lease rentals that are paid to the SPV essentially serve the coupon payable under the sukuk certificates. And this can be set on a floating rate basis every 6 months or every quarter, or on a fixed rate basis, as mutually agreed between the investors and the obligor or the beneficiary of the financing. At maturity, the assets are then sold back either to the same obligor or to a third party for a certain predetermined amount. The other option here is for the assets to be sold back for an exchange of shares of the company, which would result in a convertible bond or an exchangeable sukuk transaction. Now, the certificates issued by the SPV can be listed on any international exchange. They are traded at a premium, par, or a discount, and they offer a growing secondary market. The reason why this is considered to be one of the most versatile forms of Islamic finance is because the certificate represent units of ownership of an asset and hence can be traded in the secondary market, which is a welcome change from some of the more traditional structures where investors had to take a hold to maturity view on their investment because they could not sell the receivable-based instrument that they owned. To put this in the context of the real world, I'll just share with you a case study on a recent sukuk transaction that Citigroup has led. This was part of a $3.25 billion financing package that we structured for Dubai Ports. The transaction was done just before the recent financial crisis in the summer of 2007. The issuer wanted to raise this amount of capital, and we advised it to tap into all possible sources of liquidity. So they opted for a 10-year sukuk transaction alongside a 30-year conventional bond. Both transactions were sold globally across the Middle East, Asia, and Europe, as well as in the U.S. market. In fact, this was the first 10-year sukuk ever to be sold in the U.S. market. Now, the pricing of this transaction was done in line with other single A-rated issuers. It was priced roughly about LIBOR plus 115 basis points It was listed on the London Stock Exchange and the Dubai International Financial Exchange. The underlying assets represented part of the port assets owned by Dubai ports in the UAE. As you can see through the distribution pie charts, the Middle East geography comprised roughly 36% of the order book. In total, we raised about $2.1 billion as against the $1.5 billion required. There were 68 investors in the order book, and roughly about 25% from the US, 18% from Asia, and 21% from Europe. Now, if the issuer had opted not to do an Islamic transaction, as they did for the 30-year, then the Middle Eastern component would probably have been much less, and they would have had possibly got to pay a higher price because there would be lesser investors in the order book. Just to give you the comparison, the 30-year tranche had only 5% participation from the Middle East, as it was structured on a conventional basis. The other example which I'd like to briefly share with you is for a telecom startup company in Saudi Arabia called Mobily. This is a subsidiary of the UAE-based Etisalat company. Mobily won the second GSM license in Saudi Arabia, and they needed financing to the tune of $3 billion. Now, our dilemma in this case was that as a startup telecom company, their biggest asset was intangible. It was the license, and the license could not be assigned or beneficially sold to any investor under the rules under which the license was granted. So the concept that was used here, and we worked very closely with Sheikh Nizam in developing this structure, was essentially very similar to a prepaid phone card, in which investors bought in advance minutes of airtime from Mobily, paid the initial principal amount required under the financing, and then appointed Mobily as their distributor to sell a certain specific amount or volume of airtimes over the next 7 years, which was the period of the financing. And Mobily has also agreed to pick up any shortfall in the distribution amount for every period, which essentially gives investors the comfort that their investment will be redeemed over the period of time that was set for the financing. So this transaction paved the way for Islamic financing to be used in companies which do not have any physical assets, where investors cannot get legal ownership, or in cases where investors were essentially just looking to finance the service sector. Now, there are some misconceptions about Islamic finance which I'd like to touch base on, and also talk about some of the current debates. Firstly, there's a misconception that the lack of standardization from a Sharia perspective undermines the industry. Now, in this context, what we have to realize is that Islamic finance is still barely 35 years old if you look at the birth of the first Islamic bank in the early 1970s. This is compared to, this is a very short period of time as compared to the hundreds of years that conventional finance has been in existence. It's a rapidly growing and evolving industry, and that's where the role of students and practitioners and institutions like the LSE and Harvard Law School becomes very critical. It's important to contribute to the research and development initiatives, and also to look at ways of enhancing and accelerating product development. Now, what is viewed as a lack of standardization is very often actually a move towards innovation and a step forward for the industry. Because when Islamic financing started, the only product that existed was to take deposits, invest them in commodity-linked structures. And today we're talking about Islamic financing being used to structure global acquisitions and to finance multi-billion-dollar expansions in the region. So obviously the scale and scope of application has grown dramatically, and every time there is a new structure that is developed, the basic building blocks of that structure have to be arranged in a new manner, even though they're still based on the same basic contracts of the murabaha, the ijara, or the istisna. So that's why sometimes the context in which they're applied makes it appear as if this is something which is deviating from the past or from previously approved structures, whereas in fact it's catering to a new need or a new dimension of the market. Secondly, what we frequently hear is that Islamic finance is simply form over substance, whereas the reality is that under Islamic finance, it's the contract that makes the difference. And the form is perhaps as important as the substance. The mere fact that it caters to the same end need of the customer is basically because Muslim customers have the same financial needs